Hello, and welcome to this series on financial crime. In the current economic climate, you'd be hard pushed to find a global growth industry. But there is one, and sadly it's financial crime. Yet too many of us in both our professional and personal lives think it'll never happen to me. It can, and it does. So the aim of these short briefings is threefold. To show you the scale of the problem, the legislative and regulatory backdrop, and to explore what you can do personally to protect your firm, your customers, and you from being used for financial crime or becoming a victim of it. If complacency, it'll never happen to me, is the biggest risk, let's start off by looking at the scale of the problem. Traditionally, financial crime, like insurance fraud, has been viewed as a victimless crime. Unless, of course, you are one of the 2 million people who have been a victim of identity theft. The numbers associated with financial crime are truly staggering. By the end of 2009, fraud was costing the UK £30 billion annually. Annual profits from drugs are in the region of 600 to 700 billion, and 5 billion of that ends up in the UK financial markets. So what are the sorts of crimes that we can actually be confronted with? Money laundering is a good place to start, if only because procedures and controls are an explicit regulatory requirement for many financial services firms. It's also one that's addressed internationally via the Financial Action Task Force and in the UK through the money laundering regulations. These themselves are a product of EU legislation. But it might be, though, that for many companies, the sum total of their financial crime training is just the annual money laundering test. But it's not a waste of time. The Financial Services Authority estimates that £25 billion of dirty money is laundered through British financial institutions every year. Well, what is money laundering? Well, it aims to turn dirty money or other proceeds of crime into apparently legitimate assets, and it's done through 3 stages: placement, layering, and integration. The first stage, placement, converts the ill-gotten gains into an asset, usually through a cash purchase. Layering is a whole series of transactions attempting to disguise, camouflage, and conceal the original source. Integration is the final conversion into a legitimate asset or cash flow. In later briefings, we'll look at potentially suspicious transactions, especially in placement, where they're easier to spot and therefore the most risky stage for our criminal. But this prompts a key message. Criminals exploit soft targets. A firm which doesn't believe it'll become a target, doesn't bother with processes, controls or checks, or doesn't believe in training its staff, is a soft target. So are you or I when we put our bank statements and credit card receipts straight into the bin. Firms are not just at risk of being used for money laundering. You could say that if a criminal is successful and never caught, a firm might not actually suffer any direct harm. But that's far from true with the next type of crime. Fraud will have direct consequences. To an extent, fraud is linked with many types of financial crime: fraudulent claims, identity theft, insider dealing, and internal fraud committed by staff. The Fraud Act of 2006 clarified the definition of fraud, aiming to make convictions easier through introducing 3 offences: false representation, failing to disclose information, and abuse of position. So let's quickly visit these types of crime in turn. Traditionally, the insurance industry had a higher tolerance of fraud than other sectors. We accepted more so as not to alienate honest customers. But this makes us a soft target. However, if insurance companies choose not to investigate or pursue suspected claims fraud, which can add another 5% to every premium, are we protecting genuine customers? Are we treating them fairly? Fraud could reach 2.5 billion by the end of 2010, and it can take many forms. At the outset, there's underwriting fraud, deliberate misrepresentation or non-disclosure. If a genuine claim is subsequently made on the basis of this misrepresentation, this in itself is fraud. We can categorise claims fraud under three groups: opportunistic, exaggerated genuine claims to increase the value, fabrication of a claim for an item that never existed or was previously disposed of, deliberately causing damage, fictitious events or circumstances of a genuine loss made to fit the policy. Serial fraud. If fraudsters can get away with it once, they may be encouraged to repeat it. For example, repeating the same claim across several insurers. Premeditated. Organised fraud. This is where criminals take out insurance policies with the specific intention of committing fraud. Another example is the staged motor accident, cash for crash, where criminal gangs set up often innocent motorists in order to make third-party claims. The FSA doesn't specifically refer to insurance fraud, but if it's a major risk to firms and customers, then we must take it seriously. What about identity fraud? A general term to cover creating a false identity, identity theft, and actually committing fraud, which could be cleaning out the victim's accounts or using that identity to commit other crimes. By the end of 2009, the annual cost of fraud was running at about £2.7 billion. It's becoming easier for fraudsters to assume a new identity and then take up positions in a business with the sole purpose of fraud. The average amount lost by victims is around £1,000, and the worst cases can take up to 200 hours to sort out. It's a priority for the FSA, and the Serious Organised Crime Agency believe identity fraud underpins much serious organised crime by enabling criminals to conceal themselves, their activities and their assets, and minimising the risk of detection. And the spread of IT makes it easier. To close fraud, we should mention internal fraud. High-profile cases of disgruntled or greedy or opportunistic staff defrauding their employers of large sums make good headlines, but thankfully are still rare. More worrying is that insider complicity counts for approximately 85% of fraud within business, another possible consequence of identity theft. Let's continue our criminal journey with insider dealing. When directors or employees of a listed company buy or sell shares in that organisation, there is a chance that they are committing the criminal act of insider dealing. For instance, a director may buy shares in the knowledge that the company's last few months' trading were better than the market anticipated. Because he or she is inside the company, they have the benefit of information not available to the general market. That is insider dealing. The same is true when staff of one company use insider knowledge of a client company to their advantage. Before we close this first briefing, we should consider a type of financial crime that's both as old as time itself and yet a relatively new phenomenon: bribery and corruption. Old because it's always existed. New because its visibility and the legislation to combat it are quite recent. In the UK, the Bribery Act of 2010 will take effect in 2011 with 4 new offences. Backhanders, brown envelopes and greasing the wheels in some parts of the world have been the norm. But the standards against what is judged ethical and acceptable behaviour are being raised. Internationally, the UN, the OECD and national governments have put bribery and corruption firmly on the agenda. Financial services firms have fallen foul of the FSA, and other large, well-known firms make front-page headlines for all the wrong reasons. As the BBC commented in one firm early in 2010, the taint of corruption and greed will cost the company a lot more and last a lot longer. Sadly, we could continue on into sanctions and market abuse, but perhaps we have enough to show you the scale of a problem that is real. Financial crime is becoming increasingly more sophisticated, with organised criminals combining them together. Identity theft to enable internal fraud. facilitating money laundering with bribery, perhaps to persuade others to look the other way. And this is equally true of terrorism, often the recipient of criminally procured funding. Much of our legislation in the UK was originally designed to tackle terrorism by going for the money. So in our next briefing, we'll look at legislation, the regulatory agenda, and why a firm should think carefully about the sorts of crimes that present the highest exposure. Thank you for joining me, and I hope you'll join me again.